Welcome to Allgen's Market Update. Today is August 12th, 2019. My name is Jason Martin. Today I want to cover some of the main highlights that we're seeing right now in the market. Just a quick review of July and going into August and kind of what we see going on in the future. So something that happened over the last month is that the S&P 500 hit an all-time high. The problem is, it all sounds good, but the problem is it did it with very little conviction. Now what does that mean? Now when you do something with very little conviction, typically it doesn't feel like it's really going to last, right? So the same thing in the market. With the S&P 500 hit an all-time high, and it did it without that momentum, without that conviction, without that feeling that it's going to keep going. So what I pulled up here is a chart of the S&P 500, and I'm looking at it all the way back to 1985. And what we've seen is the market's going up, but is doing it with little conviction. And what that means in terms of technical analysis, it's creating what's called a negative divergence. So let me explain that. So again, this chart goes back to 1985. This is the S&P 500. And I point out 4 times in history here where the market went up while one of the momentum indicators called the RSI is going down. So let's go through history real quick. You can see here back in 1986 and 1987, has the market hit a new high, the RSI hit so the market high went higher than the prior high. When you're in a strong market, the momentum indicator is also supposed to do that. It's supposed to make a higher high as well. But you can see here, this high is lower than this high, which means that's a negative divergence. That happened right before the 1987 crash. So, and then fast forward to the late 90s, as the market continued to make higher highs back in that tech boom, in the dot-com bubble, the RSI was making lower highs. See how the highs are declining here, whereas the highs are increasing here? That's a negative divergence. That's showing a lack of conviction. That typically happens towards the end of a market run. And then one more time in 2008, in 2007, when the market kept making new highs towards the end of its bull market run, and the RSI here made a higher low prior to the market falling. So fast forward to today. Just recently, this little blip right here is kind of June, July, where the market went into an all-time high, the S&P 500 did, and that's the 4th consecutive higher high where the RSI, or the relative strength indicator that measures momentum, has made lower highs. That's a clear negative divergence. Now, obviously, that doesn't mean that for sure the market's going to drop. Unfortunately, I don't have those types of tools that give us the for sure thing. But what it does mean is it's a red flag. And so it's something that we want to really be careful and really watch over, because when the market's going up without much conviction, a lot of times it runs out of momentum, it runs out of buyers, and it's just a red flag to be careful with. So we're watching it closely. Another thing that we're seeing right now is the world ramping up. It's a currency war. So the big news these days is that you have the China trade war, you have tariffs, you have all these things. But really, I think the bigger story is that people aren't seeing as much is what's called a currency war. Now, what is a currency war? Right now, the world, the bigger developed countries around the world, and China included, is trying to devaluate their currency. And there's a couple reasons for that. One reason is it makes that particular country more competitive in terms of the global economy and selling its goods and services. That's one reason. But I think the main reason that this is happening is because the developed world has a lot of debt, the U.S. included. U.S. has $22 trillion in debt, and the debt to GDP, depending on which measure you're looking at, is getting very high, right around 90%. And so one way to get out of debt, and I don't necessarily agree with it, but it's what's happening, is you can devaluate your currency. So if we have to pay back as a country, U.S. as a country has to pay back our debt, $22 trillion, with a really strong currency, it means we pay more money back, relatively speaking. Okay, but if we can weaken our currency, then we pay less money back, relatively speaking. So the way the world reduces or devalues its currency is either one, it lowers its interest rates, or two, it either lowers the interest rate, or it also does what's called quantitative easing or printing money. So we've seen Europe recently and the ECB, the European Central Bank, lower interest rates even further recently, or talk about doing it even further, going further negative. And for the first time in 10 years, the Federal Reserve just lowered its interest rates. So that could potentially decrease our currency. So let's take a look here. This is looking at the Fed. I often show this, but I'm showing a different time frame. This is looking at the Fed futures rate. So basically, futures predicting the probability of future Fed rate drops, okay, or where the Federal Reserve short-term rate will be at a certain period in time. Right now, we're looking at April 2020. So the highest probability right now in April 2020 is that we'll be at 1.25% to 1.5%. So what does that mean? We just came from 2.25% to 2.5%. So that would be a full 1 percentage point drop, or 4 quarter point drops from where we just came from. And so, and there's actually probabilities that it will be dropped even further. So as the United States now starts to lower its interest rates, and you have Europe that's already negative, Japan that's near negative interest rates, the world as a whole is, especially the developed world, is trying to reduce or devalue its currency. That type of move is an inflationary type of move. So what does this mean for you as a client and as in our portfolios? Well, one thing that we believe could be a good diversifier is gold. We haven't owned gold in a long time. In fact, really since kind of 2011-12 time frame, we haven't been in gold. But right now we're seeing a trend that's setting up right here. As you can see, kind of before I show the trend setting up, this is 2001 going all the way to 2011. Gold had a really nice run during that time and peaked out, close to 1900. Well, since 2011, when it peaked out, it's been drifting lower. And so, then it created this base where it went sideways for quite some time. We've now started to break out of that base and break out of that downtrend. And I believe that's because the world is trying to devaluate, the developed world is trying to devaluate its currency. That could be a good thing for gold. That's an inflationary type of thing. Gold typically does better in an inflationary environment. Now, I know if you look at the CPI and certain things, it doesn't look like there's a lot of inflation, but when the world is devaluating its currency, there's a possibility it could come. And even if it doesn't come, you just have to have the perception that it's coming for a real asset like gold to go higher. So just to kind of quick review, the S&P 500 hits new all-time highs, and then, but it does it with very little conviction, and there's a red flag because it's creating what's called a negative divergence. In fact, last week was a pretty volatile week. After the market hit a new all-time high, the Dow made a huge down, or the market as a whole had a big drop. In fact, you see headlines like Dow down 800 points. And by the way, I want to remind everyone, when we look at those types of things, when we hear those things on the news, try to think in percentages. Still a big drop, but just a quick reminder, please think in percentages. And really, the Dow's only 30 stocks. Focus on the S&P 500 and some of the other main indices. But I digress. So the other things that are going on is that the world's ramping up a currency war, and futures are predicting lower interest rates to come. And so because of that, we believe gold may be a good diversifier, and so we've started adding gold to our portfolio. Obviously, this isn't a recommendation for everyone to buy gold. We're doing it for diversification to protect our portfolios, because our investment philosophy is to manage risk first in order to preserve and protect accounts from big drops. And then we also want to do well over the long run. So we appreciate you as a client, and we thank you, and hope you enjoyed this. Have a great day. Take care.